Welcome to Season 2, Episode 8 of Wattle Partners Market Thinkers Series. As usual, I'm joined by Drew Meredith, my business partner, and our guest today is Chris Joye from Coolabah Capital. Afternoon, Drew. Afternoon, Chris.
Afternoon, Jamie.
Fellas. Good to see you, Jamie. Good to see you, Drew.
For the regular listeners, everyone will know that this season we've been talking about big themes and how it's incredibly important for anyone that's managing money to understand the themes that are playing out domestically and around the world. And today, the theme that we have to talk about is real estate and, to a smaller degree, monetary and fiscal policy. But real estate being, as most people know, Drew and I manage money for mums and dads, and traditionally or typically their biggest asset or one of their biggest assets is real estate. So investors are always concerned about real estate, and it feeds into so many different things in the economy. So Chris, I don't think we don't need to introduce you. Everyone knows who you are. So we can get stuck into it straight away. Drew, do you want to kick this bit off?
I just had an easy one for you to start, Chris, which was, how did everyone get it so wrong last year? Things like property prices, market collapse, economic disaster. You were like the only person, I think, that wasn't predicting Armageddon.
Probably 12 months to the day, Drew. You know?
I think it is. Yeah. What happened? How did you get it right? How did they get it so wrong?
Well, we were probably lucky. And
Don't say that.
Ironic and sad thing is, I don't really believe what I just said. But I think it's a classic mistake. People always extrapolate out from the current event they're looking at, and they don't think about the second order derivative reaction. So for some reason, even though it was obvious we'd get a lot of monetary and fiscal stimulus, people seemed not to have accounted for that. And that was the key driver of our view that economies and markets would bounce back very quickly, and also a key driver of our view that the housing market would recover quickly. And I mean, obviously there was more nuance. We also, beyond forecasting house prices would only fall 0 to 5% and then start rising again in September. We also forecast that we'd get vaccines developed and approved last year, and we forecast a very strong economic recovery, much firmer than what any other analysts had in mind. So we argued that the unemployment rate would quickly settle at 6 to 7%, when Treasury and the RBA were thinking it would rise to 10% or higher. So I think just overlooking that second order stuff is the trap that people fell for.
How do you forecast that? What are the inputs? I assume you have the same inputs as everyone else.
Well, you've got to forecast what is called the policy reaction function. Basically, you've got to be able to predict how Treasury and the RBA will behave. And I think I wrote an article in the AFR. Well, I wrote one on the 28th of February saying there's going to be a complete market meltdown that's going to require extreme QE. And initially the central banks didn't believe that. And so they're actually a little slow with the QE initially. And then I think I wrote in the AFR on the 17th, or maybe even the 18th of March, that we would get extremely aggressive QE from the RBA, and also QE from the Treasury and the RMBS market. So we'd get the RBA buying government bonds and Treasury buying residential mortgage-backed securities, and they announced that 2 days later. I think that...
Do you think that's nearly an automatic stabilizer we should count on in crisis, that there will be always fiscal and monetary policy to support whatever crisis we face?
Well, I mean, ex post facto, after the event,
sure,
everybody talks about the Greenspan put, the Bernanke put. But it's kind of like in the throes of the crisis, everyone assumes that doesn't come to pass. I mean, we spent almost $900 million buying assets in the month of March when all of our peers were rushing for the exits or their funds had frozen because they had no liquidity. We traded in March alone $1 billion of bonds, and we sold about $100 million in March, no problems with liquidity. And we sold $720 million in the month of April when markets were still very fragile. But I think what people miss is the nuance and complexity of life. And the more I think you accumulate experience, the more you learn to appreciate the importance of really dwelling on the tails of the distribution, the left-hand side and right-hand side tails. And that's kind of what we did. We spent a lot of time doing in particularly February, March, April, May, June. We built COVID forecasting models that predicted the first waves would peak in very early April all around the developed world. And that's exactly what happened. And the epidemiologists were saying, no, the first wave won't peak until, in about 6 months' time. You might remember the Prime Minister ScoMo, actually, when they put us into lockdown in March, he said it was going to be a 6-month hibernation.
It was in Melbourne, not in Sydney.
Yeah,
that's right. So what the model suggested was that lockdowns are highly effective. But I guess what we've learned and what the models didn't predict is the second, third, and fourth waves. They weren't designed to predict that. They were only designed, our COVID-19 forecasting models were only designed to predict how the first wave would evolve if you brought to bear a aggressive and sensible lockdown. So I think that in life, it's much easier to assume away all that complexity and jump to simple conclusions. It's all good or it's all bad, and not to try and understand the true probability distribution that we face, which is awfully complex. But I think in the macro domain, we, if I can say so, have done a really good job projecting unemployment, credit spreads, house prices, COVID innovations, vaccine development, fiscal policy, monetary policy. We've recently had a very contrarian view that the budget deficit would be a lot smaller than what the government was forecasting. Now, the government released the budget in October, and it predicted a $14 billion deficit this financial year. And we've been banging the table since October saying that's totally wrong. It's going to be much, much smaller. And now the government is fessing up to the fact that it looks like it'll be 64 billion smaller. So only 150 billion this year.
Managing expectations to deliver a surprise when they do a May budget.
Yeah, I think so. I think actually we're all going to be surprised by. Again, we've been arguing since COVID that we're going to be surprised by the strength of the rebound, and I think that global recovery will be a big thematic of 2021. I think we spoke about this. I'm sure we spoke about this last time, that we were super bullish on growth and the rebound and housing and a whole bunch of other stuff.
And we know, your investment isn't in housing, your expertise isn't in housing, but your whole strategy is based, or not your strategy, your business is based on investing in the debt, equity, different levels of the banks, which are reliant on housing. So you've got pretty strong views on that. What do we just had the strongest month on? Was it on record? Everyone likes to say on record. It's probably only 20 years of records.
Say on record.
On record?
Yeah, on record.
Yeah, I think, again, that hasn't been surprising for us, because in March, we actually said house prices would fall for 6 months and only fall 0 to 5%. But then we expected them to increase by 10 to 20%. And the increase started in September. And that prediction was based in the movement in mortgage rates from April 2019 onwards. And initially, we actually first made this prediction in April 2019. We said it was reasonable to think house prices would rise 28% based on our modelling. And that modelling just focuses on purchasing power, so incomes and home loan rates.
Yep.
And we said in April 19, we thought house prices would rise 10% over the next year, and that's exactly what happened. Then they fell about 2%. So technically, we were still owed about 20% growth, which is why we said we expected another 10 to 20. However, mortgage rates have fallen a bit further than we expected in April 2019. So 3-year fixed rates are actually down 1.6%. So if we account for that, it's more likely we're going to get capital growth of not 20%, but something closer to 20 to 30%. And this year we were expecting last year 10 to 15% growth. And I think the risk is it's at the upper end of that range, if not above it.
And it rates Sorry, go ahead.
Well, all that's happening here is, we've never seen mortgage rates below 3%, let alone 2%. My 3-year fixed rate loan is 2.0%. And so house prices have to adjust to that change in purchasing power. It's not a bubble. It's not irrational. It's just the asset pricing process. And I've got to tell you, as you guys know, every analyst in the country in March last year, including all the banks, were forecasting house price falls of 10, 20, 30%. And I don't know how they got it so wrong. It really is quite breathtaking, the collective stupidity of the forecasting community. It's quite amazing.
I write regularly about economists, if that's a word, or forecasters. So completely understand it. And so you're talking about there's no bubble at the moment. Everyone likes to predict a crash. It seems to draw headlines, but property prices don't have to fall 30% to become affordable, do they? Is kind of what you're talking about. There doesn't have to be a crash. Incomes can catch up.
That's right. And we saw that actually, between 2017. So from mid 2017 to the end of last year, Aussie house prices only rose by about 0.5% annually. And our wages were growing at 2%.
Yep.
Wages were growing at 4 times the pace of house prices between mid 2017 and the end of 2020. So the reason house prices are booming is because there's been a huge increase in affordability.
Is there a bit of an overlay of supply and demand or immigration? Is that a longer term concern, or?
Yeah, so population growth, immigration and supply, they impact underlying housing demand and housing supply. Obviously, building approvals impact the supply side. And what we're talking about is the market demand. So pricing power, purchasing power, and the fact that there's been this big shift, so an unprecedented reduction in mortgage costs, that means house prices need to increase 20 to 30%.
So essentially, all I'm being a property owner, the only two things I'm really worried about is wage growth stopping or decreasing, and potentially mortgage rates getting higher. In
the short term. In the long term, the structural demand and supply factors have an influence. So that'll be immigration and building approvals. Now, whilst there's no immigration right now, we are expecting an immigration boom over the next 5 to 10 years. So I think you're actually going to see massive migration into Australia. And you're also going to see population growth because a lot of expats are returning. So huge numbers of expats are returning to Australia. So that's positive. On the supply side, there has probably been some excess building in the apartment market, but that's only a relatively small percentage of the overall housing stock. And I think that will get soaked up by an investment boom. So whilst we haven't seen much in the way of investor demand for housing, with gross rental yields, at 4 to 5% plus in some capital cities, I think you're going to see a lot of investor interest over the next 12 months. I think the dial on the demand side will start pivoting away from first-time buyers to investors, which is, again, a perfectly rational response to the fact that apartments and some houses in certain cities look very cheap, compared to what you can get, in TDs, so in cash or in other asset classes.
And what's the more important input into the economy? The cash rate, the 3-year, the 10-year government bond? I mean, they're all pretty much, apart from the 10, they're at the same level, aren't they? So we're very close.
Yeah, so for, I think, the Aussie economy, most housing borrowers have been variable rate, and their loans price off the cash rate. That's been about, historically, 8 in 10 borrowers. 2 in 10 have had 3 or 5 year fixed rate. It has changed recently. So the share of fixed rate borrowers has jumped to 40%. But they're still mostly fairly short-term fixed rate. So again, typically about 3 years.
That includes you, Chris. You said you had a fixed loan before, fixed home loan before.
That's right. Yeah,
did you used to have a variable loan?
Yes, I did. Yeah.
Yep.
So I went to fixed.
Yep.
Normally, as historically the cash rates come down, you've always been better off going to variable rather than fixed. But given the cash rates hit basically 0.1%, you're now probably going to be better off in fixed rate loans than variable rate loans.
Will it go negative?
It is possible. It could go negative if we get hit by a big shock. So another sort of external event, it could easily go negative, the cash rate. But the RBA is very, very resistant to that idea. And so I think the next move probabilistically should be up. I should say the 10-year government bond yield doesn't really have an impact on Aussie house prices at all. No one borrows off the 10-year rate. And that's why when the RBA does QE and buys government bonds, it's buying typically 5 to 10-year bonds. And it is therefore really impacting the borrowing cost, or the cost of borrowing at 5 to 10-year tenors, which are really only relevant to government agencies, so states and the Commonwealth, and to longer-term corporate borrowers. That doesn't impact the housing cost of borrowing.
So we're sticking with that policy and quantitative easing theme. How do you see that playing out? You've been, basically, the RBA seems to have done whatever you said over the last 12 months. Have we got a leading indicator? I think they mentioned during the week that they're open to increasing it. Is that a currency play? Is that what the aim is, to offset the iron ore price?
Yeah, the main issue the RBA has faced is that central banks around the world have been doing much more QE than they have, relatively speaking. And that puts upward pressure on the Aussie dollar. Because Aussie interest rates, our 10-year rates, are basically the highest in the world. And what that means is a lot of people want to buy Aussie bonds.
Yep.
And that puts upward pressure on our dollar. So the RBA has no choice but to try and negate that. Otherwise, our exporters are punished, and any businesses competing against foreign imports are also disadvantaged. So the RBA, we thought they'd do QE in August last year, and I bought about 3 to 4 billion of government bonds in anticipation of them starting QE. It wasn't a conventional or fashionable view at the time, and they launched the first 100 billion in November. They've basically spent that, and this month they'll start spending another 100 billion, and which is something we actually forecast in January. So we forecast they do QE2 and another 100 billion. And again, I think we were the first in the market to call that.
You were. Everyone was surprised when it came out. So,
and then at the same time, we also forecast right at the start of February another third round of QE worth 100 billion, which should start in the final quarter of the year. So they're doing actually a great job. The Aussie dollar is around 76 US cents. Were it not for the RBA, all the data suggests it would be trading above 80 US cents. And Aussie 10-year government bond yields were about 30 to 40 basis points above US 10-year government bond yields. And now, because of the RBA, they're only about 5 to 10 basis points higher, even though we have a better rating than the US. So we're AAA rated, the US is AA rated.
and is this MMT or is it just common sense policy?
I think most of the QE around the world is MMT. I think in the case of the RBA, they are genuinely just focused on neutralising the impact on Australia of the ultra aggressive QE around the rest of the world. But at the end of the day, they are printing money.
Yeah.
And they're using that money to buy bonds issued by governments who are using that money to spend on their stimulus programs. So even here in Australia, you can easily make the case that we have a form of MMT, albeit controlled by the RBA, not by the Treasury.
Well, they say it's not modern, it's not monetary, and it's not theory, don't they? So it's kind of just the monetization of deficits.
Yeah,
which
I think
makes
that's
sense.
right.
If your
I think that's
economy
right.
stops, you have to. Why would you run a surplus if the economy is struggling?
Yeah, I think the thing that the RBA is really focused on is it needs to get wages growth in Australia up from its current level. So pre-GFC, wages ran at about 4% per annum. Today, they're running at 1.4% annually. And to get inflation back into the RBA's 2 to 3% target, they need to get wages growth of 3 to 4%.
How do you do that, Chris? How do you get wage growth?
The only way to get wages growth is to run the economy hot enough to reduce the unemployment rate down to a very low level. And that level that is consistent with 3 to 4% wages growth is, we believe, 3-point-something%. And again, we kind of flagged this in the AFR, and a week later, the governor of the RBA, Phil Lowe, was asked a question about it by John Keogh at the AFR, and he agreed. He said, that they think full employment is either in the low 4s or high 3s. So that's their target. That's their bogey. And it's perfectly reasonable for them to try and run the economy in a fairly aggressive way. You've also got to remember that fiscal policy was what really bailed out Australia and JobKeeper, JobSeeker
Sure.
in 2020. But the government has to now wind back that temporary stimulus. And so fiscal policy will actually be detracting from growth. And the RBA, in a way, is trying to act as a cushion to offset the impact of fiscal policy actually hampering growth over the years ahead as the budget normalizes back to sort of a more balanced position.
So it's about confidence, telling everyone the cash rate won't go anywhere for 3 years. 3 years now. It's more about making people confident in that animal spirits, I think they used to say in the US, didn't they? Because you need that for the economy to run and people to hire and invest.
I mean, there's a lot of people out of the workforce or the potential workforce too. I just returned from country Victoria where massive labour shortages, no new Australians and no backpackers has put enormous pressure on wages in the agricultural industry. You know, they're paying substantially more than they were paying last year and the year before. So it'd be interesting what no immigration into Australia does for a couple of years, and then the backpackers being absent from, you know, these rudimentary roles or basic roles, what it does on wages as well.
Yeah, I agree. I think it's entirely possible that we could get a significant increase in wages growth over the next couple of years, particularly if we don't get any skilled immigration. We know there's already labour shortages in markets like WA.
And do you predict RBNZ policy as well? Is that part of your inputs? If the banks have got operations over there, I'm sure you've got a model for everything.
No, the New Zealand market is thankfully a very small market. It basically has no impact on our portfolios. So I'm not an expert on the RBNZ's policies. I do think it's interesting that that Westpac is looking to sell its banking operation in New Zealand.
We're thinking, Drew, do you want to just try to bring up a sum up question?
Yeah, I just wanted to wrap it up with maybe, we've discussed everything from property, monetary policy, fiscal policy. All of our clients have investment in bank shares, hybrids, bank bonds, residential property. How does it all feed into, you know, the profit outlook for banks, the debt outlook for banks, credit spreads in a summarized fashion, Chris?
We're looking for more predictions, Chris, like the ones you had last year.
Yeah, sorry guys, it's actually a little bit busy trading wise. So can you say that question again?
It was more just a summary on quantity, more of a summary on what quantitative easing, property prices, spreads, all these things are doing to the profitability, security, and changes in even macroprudential measures in terms of the ratings and returns from banks, pref shares, and bonds.
Yeah, I think bank equity still remains a little cheap. So we're looking for CBA to trade closer to 2.25 to 2.5 times book value. We think the other three majors can trade at north of 1.5 times book value. They're all trading a little less than that right now. Certainly the recovery in credit growth in the housing market is very positive for the banks. Last year we said their provisions massively exaggerated the likely credit losses ensuing from COVID-19. And that's proven to be the case. So we're going to get large write-backs. We're going to get a substantial increase in dividend payout ratios. The banks are now massively overcapitalized. So they're going to have to return some of that capital. At the same time, TD rates are less than 0.5%. And so people will continue to search for yield. And bank hybrids, we think, remain quite cheap. So 5-year major bank hybrids are paying about 2.8% above the bank bill rate. And, in 2014, they were trading at about 2.4% above bank bills. And pre-COVID, they were at 2.6% above bank bills. So we think there's some significant runway left in the hybrid market. And we maintain an exposure to that sector. We think the major banks' Tier 2 bonds are pretty fairly priced. They're sitting in credit spread terms in or around their post-GFC tights. The major banks' senior bonds, we think, look very expensive. So we think senior bond spreads, which are probably around 45 basis points right now, will, over time increase to probably somewhere between 60 and 80 basis points. So we don't hold any major bank senior. But overall, I think, bank return on equity results should improve markedly. So I think you'll see the ROEs of all 4 major banks jump up into the low to mid sort of teen range. I think the sustainable ROE is still, as we've argued since 2015, in the very, very low sort of 10 to 12% range. But I think you'll see a bit of a fillip from, again, excess provisioning in 2020 and the artificially or exaggerated conservatism that they were compelled to embrace as a result of their excessively pessimistic forecast for housing, unemployment, and the economy. So I'm very bullish the banks. I like bank equities. We actually do trade bank equities for a super fund client, and we've made a lot of money doing so since May last year when we've been exposed to that sector. So they've been
kind of offsetting net interest margin through credit growth. And
also I think they've been able to
0.5 for TDs.
Yeah, and I think they've been able to capitalise on the very cheap money provided by the RBA. So the RBA has really helped mitigate some of the increase in funding costs that they suffered in February and March. But they've had access to the RBA's term funding facility, where they can borrow $180 billion for 3 years at a cost of just 0.1% annually. So that's a license to print money. And so I do think we'll see an increase in bank funding costs as they normalise over the next few years, particularly senior bank bond costs. But I think that this should, all things being equal, be a golden period for the Australian banking system. I think many of the neobanks have failed. I think they'll find that APRA, the regulator, will start forcing non-bank lenders, who are one of their biggest competitors collectively, to adhere to the same lending quality standards that the banks are forced to apply. That's not currently the case. So I think that competitive advantage the non-banks have, insofar as they're not regulated by APRA normally, I think that will disappear, because APRA actually does have the ability, under recently passed legislation, to regulate non-banks. So anyway, in summary, my key takeaways for the next 12 months are a big increase in house prices. I think the search for yield dynamic will remain absolutely long and strong. And I think the 4 major banks will be some of the biggest beneficiaries of the post-COVID recovery across their capital structure, particularly their equity and hybrids, less so their senior bonds. In fact, quite the opposite. So we're actually short their senior bonds in our long-short credit fund because we think that their senior spreads will increase.
Great, Chris. Always fascinating to have you on the show. Enjoyed your insights. Go and enjoy your son's 10th birthday. And from Drew and I and Wattle, appreciate your time and thanks very much.
It's great always talking to you guys, and it's fantastic having such knowledgeable and educated clients. And we've obviously enjoyed the partnership in terms of servicing your clients at Wattle, and happy to chat anytime you guys want to have a yarn about what's going on in the world, and happy to sort of ventilate our views.
Thanks mate.
Chris.
See you
Cheers.
guys.